Welcome to this Killick Explains video, and welcome to a video on New Year's resolutions. So as we head into 2022, what are some of the things that I'd recommend that we all try to do? And I speak for myself, I am not always the perfect exhibitor of some of these resolution points, but nonetheless, what are they? And I've got 5. So the first one is, people sometimes say, what do I aim for in terms of returns? The US stock market over the last 5 years has offered double-digit real post-inflation returns. So when I'm putting my savings plan together, do I build in quite an aggressive expectation of what I might earn from equities, for example? And the answer is no. All right, the past, as regulators stress, is no guarantee of the future, and therefore I think a realistic target is aim to solidly beat inflation. We all need to do that. By how much will vary. In a good year, you'll achieve it by quite a margin. In a bad year, you might not achieve it at all. But over the long term, we all need to beat inflation, because if we don't, we're actually getting poorer day in, day out. So cash accounts are a nightmare. At the point this video is being made, national savings and investment certificates, disastrous rates of interest. With inflation up at, say, let's call it 4%, cash accounts offering between 0 and 1% at best maybe, and that's for a term deposit last time I checked, just over 1%. You are losing quite a chunk of money every moment you're in cash. But don't be too ambitious. If you can get post-tax real returns at a margin above inflation, you're doing all right. You won't get it necessarily day in, day out. Markets can be volatile, but that's a reasonable thing to aim for. Rather than, I'm going to aim to beat some index by an arbitrary amount, and rather than saying, I definitely won't play this game unless I get 10%. Well, you may or you may not, but beating inflation is important. I'll leave that thought there. Now, next thing is linked to it. Don't try and second guess markets. It's the forecasty time of year when people try and predict what's going to happen next. Don't try to second guess markets. Markets do sometimes suffer quite chunky corrections. Now, when I say chunky, I do not mean 2.5%, 3%, as we've seen over recent weeks, as yet another variant of coronavirus tries to disrupt everything from the way we live through to the way that stocks behave. What I'm talking about is chunky corrections, and they do come along. 10 to 15% corrections are not uncommon. If you go back to the financial crisis, go back to the start of the coronavirus phase, go right back to the dot-com crash, you could be looking at 40, even 50%. And if you go back to the early 70s, I was around in the early 70s, in a worst case scenario, the stock market could even lose short-term 2/3 of its value. And that sounds catastrophic, but actually every single time, I don't have a crystal ball, but every single time the market has recovered reasonably quickly in a matter of years and gone on to greater and better things. So stick to a long-term investment strategy. Get your 3 pots in place that I've talked about on many occasions: the rainy day, the foreseeable calls on capital, lifetime savings. Plan your overall level of peak savings in the future, and then stick to your strategy. And by the way, one way to make sure you do stick to that strategy is just to think, what would I feel like if stock markets dropped by 20% in a year? Would I panic? Easy to say you wouldn't in advance, but would you panic? Because if so, you might need to change the blend of the assets you're holding. Okay, that's number 2. Number 3, be tax effective. After all, as you're watching this video, we'll be coming up closer to the 5th of April. All right, so good time to just think, right, what can I do to make sure I'm giving as little away to the tax man as possible? The tax person, I should say. So the answer is, why not use up those ISA allowances? ISAs are a tax-effective way to save, and these days an adult ISA can carry up to £20,000 of contribution per year. It doesn't all have to go into shares immediately, by the way. If you're nervous, get the money inside the wrapper if you like. Leave it in cash while you decide what to do with it, not for too long, and then move it out later. Junior ISAs, crikey. So saving on behalf of children and or grandchildren via their parents. Junior ISAs can take up to £9,000. If you can't take a little bit of risk when you're a child, when can you? So there's an opportunity. And then pensions, of course. Who knows whether the government will change the rules on pensions? I do hope they don't, but pensions are quite tax efficient. On the way in, you get tax relief. That means you get some money added inside the wrapper, if you like, by the government at your marginal rate of income tax. So if you're a higher rate taxpayer, every 60p that goes in on one side sort of magically becomes £1 invested. So pensions represent a pretty good way to basically wrap up money and protect it from both income tax and capital gains tax. So think about whether you're going to use up allowances well before the 5th of April, ideally. And then what I would suggest is, we've been through a pandemic. I hope to goodness at the time of watching this video we are definitively out the other side of it. But here's my next resolution, don't lose all of those good pandemic habits. I know it's been tempting for everyone to go out and splurge, and who wouldn't after a period of lockdown, but actually lockdown introduced some quite sound financial principles. People suddenly realised perhaps they didn't have to spend quite as much as they were in the past. People saved a lot of money on commuting, socialising and so on. And I'm not saying we all want to go back to living as though there's a pandemic on, but some of those good habits of saving a bit more, budgeting, thinking about how much we actually need to spend, why not keep some of those tucked away under the mattress and continue with them as we hopefully leave the pandemic well behind us. Final piece of advice is do not be dazzled. The festive season is full of dazzling things, baubles, light shows and so on, but keep your head when it comes to financial markets. We have seen, in no particular order, over the last couple of years, the meme stock surge, if you like. People piling into single stocks using apps which allow them to just push a button, bang, in you go. We've seen Bitcoin and cryptocurrencies surging, and people claiming to be crypto millionaires and all the rest of it. Whether or not they can actually turn any of that crypto into something they can enjoy is another matter. And we've also seen within the stock market, biotech surging on the back of rumours that somebody has cracked a new treatment for the coronavirus. Be careful, all right? You'll see lots of media stories around all kinds of things like that. Don't be tempted. Don't be too trigger happy when it comes to investing apps. Stick to your guns, stick to a long-term strategy, and all should be fairly well. So there we have it, 5 resolutions. Focus on inflation if you're wondering what to aim at. Worry less and don't try to second guess markets. Be tax efficient about your saving and investing. Keep up those pandemic good habits, as I've called them, and don't be dazzled. Now, to find out more about quite a few of the topics I kind of skirted over there, including crypto, if that's your thing, please do go to our extensive library, killick.com/learn. And if you'd like a copy of my guide on some of the good habits that equity investors ought to adopt, it's called How to Invest in Equities, not surprisingly, then editor@killick.com is a good place to ping an email to.